Hello, this is Joseph Gillette Sr. talking about settlement of private transactions. We did a short form video. This is going to be a little longer and more detailed. The settlement process can be very different for different types of transactions. So, for example, SPV is different than direct, is different than forward, and each SPV transaction can be different. It depends on the company, it depends on the GP, it depends on the document stack, it depends on a lot of things. Does the buyer have counsel? How fast can that counsel move? Things like that. So let's just go over what we have on the screen first. So settlement happens after execution. That means after price discovery. Price discovery is a process of the market, just like you'd see in public markets. You see buyers, you see sellers, and price discovery happens somewhere in between. So let's say you have a seller here and you have a buyer here, and at some point the price is going to match, and then you have like a cross. That's why they call it the cross. It's not connected to anything other than you have a buyer and a seller and they meet, and when they meet it becomes a cross because they're going to be originally at different prices. So the buyers always want to pay less, obviously, and the sellers always want to sell for more, and where that price discovery happens, that match, that's a cross. You've crossed from one side of the market to the other side. Okay? So after execution, that's where settlement happens. So once you have a price match, it executes. Then you're going to, the buyer is going to purchase the shares and the seller is going to deliver the shares. So if we look at this like a traditional securities transaction, you're going to prepare some agreements, and the first agreement is going to be transfer notice. And it's a binding document, and that's going to be sent to the company, and the company is going to be noticed or notified of a pending transaction, and you're going to have the buyer's name in there, the seller's name in there, and the share certificate number, and sometimes they will sign an LOI, and so I put that in here, but that's more of a traditional informal way of saying that we want to do this transaction, but it's non-binding, so people kind of skip it because it's kind of worthless in some way, but some people still do it, and that's fine. It's okay. It's okay, and sometimes they use the LOI to show their investors, look, we have a transaction, they're committed. Kind of like if you're interested in a merger and acquisition transaction or buying a big asset, you might sign a memorandum of understanding. It's more like ceremonial, let's put it that way. It's more ceremonial. So then you're going to sign the binding transfer notice. If it's direct, you're going to notice the company. Now the company can do several things. They can approve the transaction, they can decline the transaction or block it. They can ghost you, which means they don't respond at all, which is kind of the worst situation, but it's pretty rare. Or it can get ROFR'd. Now, if a ROFR happens, that means an existing buyer on the cap table is going to buy the shares. So in a ROFR, the seller is still going to get a transaction, the buyer is going to lose out. And for that reason, some people put a breakup fee into a transaction where everybody gets paid in the event of a ROFR, and it's built into the price. But those are the different things that can happen. Now, once the company approves it, and if it's a ROFR situation, the company has approved it, it's just that the buyer is going to be different, so you're going to have a new buyer. So whoever's buying the shares, then you're going to sign the share purchase agreement, and that has to be provided by the company, so you can't have your attorney draft a share purchase agreement. That's got to be the company's share purchase agreement, not something that you found online or something that your lawyer drafted. It has to be the same for everyone, pretty much. The company doesn't want, for example, think of the chaos if a company was making side deals with every single investor, different agreements. It would be just very difficult in the future when people wanted to sell, because how do you value different assets? So shares of a company, because they all have the same agreements, are pretty much fungible. Now, the one carve out of that statement is that sometimes companies will structure different classes of shares for different features and for different investors. So for example, you might have a Pref D offering that has certain liquidation rights or certain voting rights or other kind of rights. Liquidation is if the company is liquidated, the preferred shareholders are going to get the assets first before the common, things like that. Preferred shares sometimes have no transfer restrictions, so you can sell them at any time, and for those reasons they sometimes fetch a premium. So for example, if you have shares in preferred shares that have this transfer free no transfer restrictions, you wouldn't have to go through all this process. You would just notice the company and they would transfer it the next day, as they could do this just immediately. So after the company is approved and noticed, they've been noticed and approved, and then you sign the share purchase agreement. Then the company receives that, and then the buyer wires the seller. Once the seller receives the money, they're going to tell the company, I just got paid. Then the company is going to say, okay, we're going to change on the cap table the name on that entry of those share certificates from the seller to the buyer, and only the company can do that. So there's very low risk of something being hacked or going wrong, because the company maintains their books and records. After that happens, then the company is going to assign shares to the buyer, and then the transaction is closed. And then everyone is notified the transaction is closed, and the company may issue a welcome kit to the new shareholder. In some cases, they're always going to do their due diligence on the new buyer, regardless of if it's a big buyer or small buyer, because they want to know who their shareholder is. So that's basically the settlement process. Obviously, there's a lot more to it, but just putting it in a short form. And we're having a learning section on our VC Cross portal. Go to vccross.com/learn to learn more, and we'll see you in the next video. Have a great day.